Hi, this is Richard Evans from GAAP Bookkeeping and Accounting Services, and here in Screencast 10, I'd like to discuss what we mean when we say that the financial statements that we prepare are audit ready. As businesses or some businesses grow, they require a capital contribution or institutional financing. When that occurs, depending upon the amount that is needed, the institution or someone considering an investment in your company usually asks for a tax return, but at times might ask a CPA to prepare either a compilation, a review, or an audit. When we say that your financial statements that we prepare are audit ready, it means that we go through exactly what a CPA goes through in order to make sure that every item in the financial statement is correct. We keep everything in an orderly fashion that can be presented, and easily a CPA can gain confidence in a number of years that we've prepared. It's exactly what they would do. And so here you're looking at a balance sheet, and let me quickly review. You can see that here cash and equivalents are $125,000. Imperative that bank reconciliations always be done and presented with the financial statement. Your accounts receivable, you have to make sure that those receivables are actually current receivables and that they're trade receivables and not mixed with other type of receivables, perhaps from employees or other places. The inventory, we usually take a monthly physical. When that can't be done, if the business is too large, we might take an annual physical. That will detect certain things that are very important. Is theft going on? Is there a problem with the inventory system? Whatever we come up with on the physical inventory was plugged in and compared to what we have on, let's call, a perpetual inventory, and when it's compared, we will adjust cost of goods sold accordingly. If it's a huge loss, we might call it an extraordinary loss or gain, either way. Prepaid expenses usually involve things like insurance. You may pay your insurance all at once, or like in the case of workman's comp, they may allow you to pay over 9 months while we're taking the expense over 12 months. Current liabilities, just like accounts receivable, we need to make sure that it is the current debt that is payable. Normally a test is done and everything in this $45,000 should be paid within the next month or month and a half to each vendor that's recorded here. Accrued expenses are expenses that aren't picked up in accounts receivable but are due. For example, property taxes. As you know, you pay that once a year, and so they should be accrued. You can pick up all of them in the beginning of the year and then amortize them over the 12 months. There's various ways to do it. And your notes payable. Now this is important that we break out from long-term note payable the amount or the portion that's due within the next 12 months. And so you see here $28,000, and we're showing that as currently due within a year. So you can see here that their current assets are $92,000. And by the way, their current or asset ratio test assets are 125 plus 35. You can see that that produces what's called a good current ratio. That's for another video, but it's a good analysis tool. And of course, those analysis ratios can be compared to your industry averages to show you how you're doing compared to the industry. Notes payable, again, to just repeat, this will be the portion that's due over long term. Officers may, instead of putting funds into capital stock or additional paid in capital, create a loan for themselves that's interest bearing. And then we have the equity section, your common stock, additional funds paid into equity, and then the retained earnings would be the sum of all the years you've been in business and combine all the profits and or losses that you have. So you can see each and every one of these items is very, very important. It makes the financial statement or the profit and loss statement correct, and each and every one of these, let's call them buckets, is represented by backup. And so that's what we mean when we say your financial statements are prepared and they are audit ready. Thank you so much.